Our firm is actually the only equity investor in southern Italy. So let's say we are used to environments which are not equity friendly at all. We have been established in Naples, where our headquarters are located, and now we have offices in Milan as well, although we have partners in the UK, in the US, and in Israel. Now what we do is we have two areas of investment: venture capital, the one I run, and expansion or growth capital. We look in venture capital to high-tech technology companies. With the first fund, they were focused in southern Italy. With the second fund, there will be pan-Italian companies, plus also candidate countries and Southeast Europe. And this is also our interest in Greece. We believe there is significant commonalities of cultural mindset, entrepreneurial mindset, and even from a technological point of view, we are not that so far. So this is why we also started looking to this part of, I would say, the Adriatic Sea. As far as growth capital is concerned, we look for companies. When we say small, medium enterprises, is not under the European definition, but also under the Italian definition, so which is much closer to the Greek definition. So we said companies around 5 to 10 million, which are huge, or medium-sized companies in our side, with the opportunity to growth. Namely, we said innovative made in Italy companies. And what innovative made in Italy means, we go through design, fashion, or fine mechanics, aeronautics, utilities, energy, those kind of small companies with high opportunities for growing, either through acquisition. Actually, we invested in a furniture company that acquired his main competitor located in another Italian region, and they grow up from, actually their cumulative turnover was originally 22 million. After the acquisition, we grew it up to 33 millions. So you have significant synergies of scales after the investment. As far as venture capital is concerned, our team is actually has been the most active team since the Italian venture capital industry was established in the mid-2000s. We did more than 40 investments so far. We previously ran a technology transfer fund, a digital-oriented fund, and the new fund will be focused on product and process automation. What we like to see in our company is, I perfectly agree, the team is fundamental. The reason why we want to team we focus on the team is, at the end of the day, is not just a matter of capabilities, which is definitely relevant, the ability to run the company, or to look for, let's say, open for external managers to run the company on their behalf, which is one of the first things that we usually decide together with the team before we close the investment. Are you willing to have a new CEO? If we don't see a CEO within you. So if you are open for a new CEO, then we'll search together. If you're not open for that, I'm sorry, we're not the right partner for you. And this is just one of the examples. And as far as venture capital is concerned, we look for very sound and globally oriented revenue models. Many often we do see very nice technologies. I'm an engineer, so I like technology. Nevertheless, technology are not basically at the core of the business. So either the technology and the intellectual property is something that enables you to raise barrier to entry and protect your revenue model. But if you don't have a revenue model, which on simple terms means you have customers willing to pay more than your cost, and believe me, sometimes it's very difficult to make it understood to a researcher, then you don't have a revenue model after that. So this is actually what we look for in venture capital. In venture capital, we do investments from pre-seed up to later stage investments. As I said, we managed the first technology transfer fund in Italy, so we work with research centers. In terms of how we help a company growing up, as I said, we try to establish a relationship of trust with entrepreneur. And the reason why we need trust is, first of all, a private equity or a venture capital will be your business partner. And it will be your business partner for a long time. So if you don't trust each other, believe me, there's no way to work together. So it's not about money, okay? Forget the money if you don't trust the person you have in front of you. And second, whatever is the contract, the investment agreement that you have signed, and whatever is the strength of that investment agreement, if we start litigating on the investment agreement after 4 years, everybody loses, okay? Everybody. So, again, if we don't trust each other, then there is no way to go forward. And if we trust each other, then we can help entrepreneurs. And when I say we can help entrepreneurs, Daniela made a nice point. I can't see her anymore. But when she said even banks sometimes are scary entrepreneurs because they want more control, etc. Now, the way we try to trust entrepreneurs is to bring together with our money our experience. I make you an example. We have been the first investing in Calabria. Now, I don't know how much you're acquainted to Calabria. It's very south peninsularian, okay? It's one of the southern peninsularian regions in Italy, very known for one of the biggest multinational companies that we have, which is 'Ndrangheta, which is stronger than mafia nowadays in terms of turnover. And we have invested in a village in the mountain of Calabria. Now, that company is a company with a high-tech technology. They have machines for distributed manufacturing of mortars, building materials, powders, okay, chemical powders, which can be manufactured in a distributed way with what I call the Nespresso business model. Still, the company is located there. Now, that company was established by two brothers, very young. I personally run a manufacturing line for robots and automated machines. Now, when it comes to the company to start growing, and I see there was a limit in the abilities of those guys to run the company, based on the trust that we establish each other, I say, guys, believe me, I have run such a company for 5 years. Would you give me the keys of the companies for a while? I will make the full reorganization, then when you start running the company again. And this is what I'm doing right now. So I believe that the way we help companies is sometimes stepping in based on the trust that we have established with the entrepreneur. And in order to protect our investment and the money of our investors, we sometimes reorganize the company, we manage the company, and we launch the company into growth. Sometimes we have to change the management, again, with agreement of the shareholders. But this is the way, especially in venture capital, you have to act in order to make company growth.
Thank you, Nicola. Since we mentioned about listed venture capitalists and or not so listed some case, and listed middle to higher private equity funds, I just wanted to come back to Hannes and ask you, Hannes, whether you see from internationally paradigms of companies or that use other innovative instruments in a way to finance themselves, and if you can give us some examples.
If you have a look worldwide, what is working and what is not working, we see very good example what is working. Instruments which are very successful and help to raise capital for small and medium-sized enterprises. A very good example is in the UK, the Venture Capital Trust, as already mentioned by Russell before, which is a listed vehicle on the London Stock Exchange, for example, which invests in private, unlisted, small and medium-sized enterprises. When in the US you have business development corporations, where the companies which invest in unlisted companies as well as in listed companies which have a market capitalization of less than 250 million US dollars, and some of them get listed by themselves as well. Both company types are targeting private retail investors, so rarely you find institutional investments in it. Another good example is in Canada, the so-called capital pool companies. A capital pool companies is nothing else than an entrepreneur decides to found a new company but doesn't have any assets or operations. It only goes to the Toronto Venture Exchange, lists the company, raises capital, and afterwards, with the raised capital, the entrepreneur acquires specific types of companies. So you see it's more or less a shell company which will be listed, raises capital, and uses the capital to buy into companies, which prove to be very successful, and even the companies benefited out of it, which were acquired, as well as the stock exchange, because many of the companies which were founded as capital pool companies afterwards ended up in the prime market as blue chip companies. And they employed more people and really helped to drive economic growth in specific regions of Canada. Another good example is in Malaysia, where you find the listed infrastructure corporations, where the companies which raise capital over the stock exchange to implement specific infrastructure projects. A minimum requirement is that the concession or license is at least 15 years. And here, mainly retail investors are invested because it's a yield-generating company, it's quite profitable, and there's a security over a specific period of time. We also see additional instruments, that is the securitized asset-backed SME loans. So where loan providers package SME loans, which are quite short in size, quite small in size, with short tenors, and normally relatively high interest rates. And a very good example is Alibaba in China, which securitized the microloans and listed them on Shenzhen Stock Exchange. And it was immediately oversubscribed. A similar instrument or a similar thing was done by BNG, a Portugal bank, which also bundled the SME loans and brought them to the exchange. And in some countries, you find specific market segments for asset-backed securities, which are also quite successful. What we see more and more are also refinancing instruments, for example, where international finance institutions or government issue so-called green bonds to use the proceeds of the funds raised to support energy efficiency projects, waste management projects, where also indirectly small and medium-sized enterprises as subcontractor benefit out of it. And what is very interesting in the US you find a specific trading platform for receivables, where receivables are quite actively traded among the different companies.
Thank you for enlightening us on those examples, and we see lots of listing there. So maybe I could come back to John and ask him what would be the advantage that you see mentioned before also by Michel and also by the previous speakers of listed funds. What would you see the main advantage, and how can we apply it in Greece to close the funding gap? The previous panel mentioned it's pretty high, above 10 billion euros.
Okay, thank you for that, Nikos. I mean, the first and simplest answer is that listed private equity funds allow private investors to get involved. So they can buy 100 shares, they can buy 1,000 shares, and at some stage they can sell those shares. And as Michel demonstrated, some of the long-term returns have been extremely good. On a more technical note, there is an element of permanent capital here, both for the managers of the listed private equity funds. They know they've got that money for a considerable length of time, decades in some cases. And secondly, for some of the underlying businesses that are being invested in, there isn't quite the same pressure to match an existing timetable to an exit. These businesses can come to fruition at different speeds, and this fund structure permits that, because you've got an underlying diversified portfolio of private companies in the wrapper of a listed vehicle. I mean, the next reason I'd cite is that such funds can bring in, I've touched on it slightly, funding from sources that otherwise would not invest. Listed private equity, by having the creation of such a sector, it raises the public profile, and I think that's pretty important. And there's even, finally, a patriotic aspect. I mean, if you launch a fund and you say this is a rescue fund, please invest in this listed private equity vehicle, that there might be a success story here. So you can tell I'm a huge fan of these funds, but I think the second part of your question is slightly harder, Nikos. I would see listed private equity as being part of the problem, part of the solution, I beg your pardon, one weapon in the arsenal, but not enough to win the entire battle.
Okay, thank you. Speaking of weapons, maybe coming back to Russell, what was the weapon that created the VCTs successful in the UK?
Sure. I must admit, I'm not too sure what the weapon was, but I'm glad to get the question. But VCTs were set up in the mid-90s in the UK, and as I think has been mentioned by a few people, they're really a retail-focused listed vehicle for investing in private equity. And the way in which they attract the investors, and probably the only reason they attract the investors, is the tax breaks offered to the investors that invest in the funds. So if someone invests £1, as we're in the UK, they'll receive 30p off their tax bill that year. Any future dividends from their investment in that fund are tax-free, and they can also offset capital gains against losses in those funds as well. So there are those 3 tax breaks for the investors in those funds that drive all the behaviour and all the interest in those funds. I think when the funds first started up in the very early days, the first funds were quite small. £5-6 million was maybe raised in the first few years. Definitely subscale. But I think the advantage of listed funds is, of course, they're a platform for future easier fundraising. So one of the challenges is setting up new funds. It's very expensive. It's difficult to build the network of potential retail investors. And really that whole market has now matured over the last 20 years. So we've got 80 funds in the UK at the moment. They manage about 5 billion euros, 30 different fund managers running those funds. And they're invested in thousands and thousands of UK SMEs. And as is the nature with tax-driven funds, the pressure on the fund manager is to make the best returns for the investors. The investors really don't care very much about anything except getting those returns. And so there's been a constant game of clever structuring between the industry and the government keeping an eye on it to try to invest in things that fall slightly outside the remit with which these funds were first set up. So the funds initially started off as almost entirely venture capital investors, so investing in quite early stage businesses, taking very high levels of risk. And one of the disadvantages that we heard from Michelle earlier of being a listed fund is that you have to publish your net asset value. And the one thing you can guarantee with a venture capital fund is that the problems will come to fruition and be written down to zero long in advance of any successful exits. So the industry reacted to this by moving to slightly later stage investments, actually the sorts of investments I talked about earlier. So still focused on small businesses, but buyouts, buy-ins, equity release transactions, rather than the higher risk venture capital, with the exception of some managers who stayed very focused or had the skills and the performance to justify that. That's all changed as of last year. So the market finds itself in a little bit of turmoil. The EC has decided that under state aid, the funds now have to focus back on venture capital. It's not retrospective legislation, but I would suggest for some of the investors in those funds, it feels like retrospective legislation. And I think really during this year, we'll understand what impact that has on fundraising. But I suspect we'll see an industry that's gone from raising about 500 million euros a year. We're probably going to start seeing that drop off quite dramatically as the risk profile changes. Not that the EC cares what I think that's a total own goal. I think replacement capital transactions, buyouts and supporting these quite often very long established SMEs is just as important as supporting the next Google or Facebook or next life sciences company. Both things have merit, both create jobs and lead to R&D and investment and further taxes within the country as well. So that's a bit of a shame in the VCT market, but over the last 20 years it's been a very successful platform. I think another characteristic that's emerged over the last 10 years is that because the investors are so driven by their returns, their yield, it's made it very hard for new entrants into that market, because any new fund is probably going to take 3 to 5 years before it can pay a dividend. And so why would an investor invest in that rather than an established fund with a stream of dividends? So I think there are some of the pros and cons that we've seen of VCTs.
Thank you. Nicola, may I just come back to you? What's your experience in Italy regarding listed VCs, since you are in the VC area more, and the private equity? Is there any type of instrument that can be used there or that can help raise capital?
Yes, there are. We have in Italy both formal private equity, listed private equity funds. But interesting, coming back to what Russell was actually saying, is that we are now seeing listed companies that actually seed and venture capital funds listed. Just to name the three that come to my mind, Digital Magic, H-Farm, L Ventures. They are actually companies that started as venture incubators or seed investors, etc., and then they went into the financial market. Now, that led to a significant boost, especially in seed and early stage investments. Having a listed fund is very important for our investors. In venture capital, even more than in private equity, we have unfortunately the hard business to link the financial needs of financial investors with the need of technology-based companies to grow. Now, the way and the usual closed-end fund works is from a financial point of view is quite a nightmare, because you see the cash flows and then the J-curve, the effect of the J-curve. So you see the money going out, and you hope that starting from the 5th or the 6th or the 7th year, you will see some money coming back. While on a listed fund, you have a more stable performance, and you have always the option to get out, to step out in a partial way or not. So this is the advantage of a liquidity or a liquid investment. And in these days, when you get around and you try to and you fundraise a fund, you'll discover that especially financial institution or pension fund, we are discussing about pension funds on the first panel, and say how pension funds are out of our business. And pension funds are looking for liquid tools, risk-free liquid tools. This is what they're looking for. So it would be definitely a good opportunity to have more and more listed funds that we see in Italy in venture capital. That would be definitely beneficial for pension funds to put the money in venture capital as well. There is also, thanks to the recent directive on alternative investment fund managers, that in Italy we have also a new tool that is actually an investment company that can be easily listed. So, and it works. At the beginning, it works perfectly like a closed-end fund, but is actually a company that can go easily into a stock exchange on the second step. So you can start collecting a fund as a closed-end fund. Once you have a portfolio, once you're ready maybe to distribute some dividends, you just list it, and you can attract further investors, and you make your own investors happier, because now they do have a liquid investment.
Hannes, you've been in the board of exchanges, you've been in the area for quite a while. How do you see the role of an exchange in order to offer access to SMEs to financing? Do you think that listed capital, listed funds, or what's your opinion, or how an exchange can create a strategy for helping SMEs to raise capital?
So what we are currently seeing is What we are currently seeing is a paradigm shift in the management of exchanges. So up to now, exchanges see the whole business more to have a lot of secondary market transactions to generate revenues. What we are seeing now on the side from many exchanges is that a multi-level structure is implemented. Started where you really try to convert the exchange to a company financing hub. And that's not a competition with banks, because World Bank conducted a study quite a while ago where the outcome was, if you have a very well-developed banking sector and a very well-developed capital market, your economy grows much faster than only have a very well-developed banking sector in place. So by converting exchanges to company financing hubs, you have to come up with a different structure. And what is currently under discussion is, how can you do that? And we also had a look internally in the bank how such a perfect model can look like. And what we see is, a company has a specific financing life cycle. It has specific needs at each point of its development. And normally it starts off with crowd financing in an institutionalized way, goes over to a private market, private company market, goes further maybe to an MTF platform or to a standard market and ends up at the end, hopefully, on a prime market. Each of the markets has specific requirements and also needs a specific set of support measures from the exchange as well as from the government. What we are currently seeing, for example, is a boom in the crowdfunding industry. It exploded from 500 million 5 years ago to 11.2 billion in 2015. So that's really a powerful instrument to provide seed financing to a specific type of companies. It does not fit to every company, but for a specific set of company, it's the perfect financing tool. Then the next thing, which is, for example, implemented already in Turkey, is a private company market. And also Nasdaq opened a private company market. A company which is more or less a playing ground for company to see, is a stock exchange listing something for me, yes or no? Can I accept additional owners in the company? Would I like to share decision-making processes, and can I ensure proper corporate governance? And if you have in mind that Facebook, and I would say 50% of you will use Facebook, was first traded on a private company market. And it was so successfully traded that Goldman Sachs already invested in that stage of a company. And at the end, it ended up with an IPO. Was not the most successful one at the beginning, but at least the company was able to raise a lot of money. And it started off as a very small company at the beginning. And you see already in some countries that a similar structure is implemented. We have it in China. In China, where, except of a crowdfunding model, you have a multi-level structure already in place, but it's not unified under the umbrella of one exchanges. There are various types of exchanges which are taking care for specific companies. Then you have Canada, the Toronto Stock Exchange Group really implemented already a multi-level structure, starting by the venture exchange and going up to the prime market. And Turkey, which implemented the private company market. What is very important is not only to have a structure in place, but also to set the right support measures. And here you have to, on one hand, rely on the government, and you have to rely on your market participants as well. Because you can have the best market segment for SMEs, but if no brokerage house is willing to serve the small and medium-sized clients because the deal size is so small, then you will not succeed. That means also here a rethinking of a brokerage community has to take place and streamlined processes to make it still profitable for them to support small and medium-sized clients. Additionally, what we have seen is very important is also market education. So market education, not only the investors, but also the companies. Sometimes the companies are not aware of the opportunities a capital market can offer them and which instruments are available off exchange as well as on exchange. And we have seen that, for example, in Thailand started an educational campaign for retail investors at the beginning and increased the size of the retail investors immediately afterwards. In Malaysia, the problem, for example, was that companies were not covered by a research scheme, specifically small-sized ones. So the government, together with the exchange, was building up a so-called capital market development fund, and the fund was co-financing research coverage. And what has been seen there is, immediately after a research was published, trading volumes increased and the liquidity of the underlying stock increased. So there are a lot of measures which you can apply to make the market also liquid at the end.
Thank you. So we don't just need to have Vienna Step, Vienna Plus, and the main market. We just need also to have the ecosystem back to place. Thank you. For John and Michel, a question coming back to the major drawback that we all know of a listed equity or listed VC is the possibility of a discount, which we see at most times. how can an investor and how can the company itself deal with it? What's the most proper way? And maybe it's an opportunity for the investor. That was mentioned before by myself. But I would like you to elaborate both of you on that.
Right, Nikos. Well, I think the first thing to say is that I'm not particularly afraid of a fund trading on a discount. It's not the end of the world. I mean, some of the funds that I mentioned on my slide earlier and Michelle's mentioned have produced excellent long-term performance, both at the price level and at the net asset value level, and perhaps they're now trading on a 20% discount. Well, frankly, some of these funds are offering tremendous opportunities to investors. And having said that, what we call discount control mechanisms have improved significantly over the years. I mean, the most obvious one is buying back your own shares. I know not all companies like to do it because you're shrinking the size of the vehicle, but it is a possibility. You can do a tender offer whereby you allow people who want to get out. And in extremis, if people don't want the fund, you can start winding it up and giving people their money back. So while it's regrettable, really, that this is a very high-quality sector that tends to trade on a discount, I think it needs to be put into perspective.
And I think as an investor, I mean, you have to have an opinion whether a discount is justified or not. I mean, there might be companies that trade a discount, and a discount is justified because, they maybe have too high management fees, or they don't have made good investments. So there might be reasons why a discount is justified. In this case, you cannot do a lot. I mean, but you have to have your own opinion on a company. On other companies, a discount is not justified. And there are some examples where you basically pay cash and get the portfolio more or less for free. When you look at the current valuations, as I mentioned in my slides, we have companies that are very, very cheap and where discount is not justified. So you should buy the company. And in case you're a big investor, you should talk to the management team and encourage them to implement a dividend policy. And I think the best thing you can do is to pay out dividends on a regular basis. And the second best thing is to buy back your own shares at an uplift. So there are some measures that can be taken by the management team, but in case a discount is justified, I mean, there's nothing you can do or expect.
Maybe at this point, just to give also the possibility for you to raise questions rather than us answering them, or the panel answering them.
May I have a question on this issue of the discount? Is it a disincentive in case of IPOs, the theory of potential discount?
Well, when we talk about of an IPO of a listed private equity company, I think it's very important.
Every initial investor is
Yes. Exactly. I think that's why it's very important for a new company, listed private equity company that wants to make an IPO, to have a clear dividend policy. I think that's the best thing they can do, because this is the question that we'll ask every investor when you have a roadshow and would like to raise money for an IPO. Every investor will ask you, how do you handle future dividends in case there is a successful exit? And you have to have a clear answer. If you say, well, we will see, investors will not buy that stock. So I think that's very, very important, especially in the current environment where everybody is looking for yield. Everybody has to accept a negative yield on risk-free asset. So the investors need yield, and they need a higher yield from other investments. So I think that's the key question and the key message: have a clear dividend policy when you would like to launch a listed private equity company.
I mean, this is the classic closed-end fund problem, is that it's when you launch, there are two things. One is there are launch expenses, which are going to come off, typically 2 to 3%, and then it's maybe going to trade at a 10% discount in the market. So, the wise investor waits and buys 6 months later for 85 pence in the pound or whatever, 85 cents in the euro or whatever. And that's always been a problem for the closed-end fund sector. I think that it's a difficulty, but a number of private equity enterprises have managed it in recent years. Serious amounts of money being raised, can be done. dividend yield. Income investing is massive in the UK at the moment, and we're getting infrastructure funds and renewable energy funds being launched on a 5% starting yield. Well, you know, people will oversubscribe these funds. It's probably a slightly different answer to your question.
Any other question, please?
If there is any, let me say, receipt making the SMEs companies more traceable, for example, do you think that the marketing regulation, meaning that it will make SMEs to have a better profile in a way, could be a good legal vehicle, legal tool in terms of attracting funds and fund managers to the companies? So do you think that this matching between these two sides is a matter of, it's a marketing regulation, or it's a market practice that can make the matching more attractive?
Normally you have a problem if you discuss with a SME, would you like to be listed, yes or no? The first thing they will ask is, what are the transparency requirements? What is the market regulation? What are the regulatory costs? So if you implement high regulatory hurdles for a company, the company will rather abstain from becoming a listed vehicle. The Prospectus Directive already now gives you the allowance to list companies to raise up to 5 million. That's normally a sufficient amount for companies, for SMEs. So that should already work. I think what is very important that the regulation of a market segment are tailored to the development stage of the companies. And the higher the market segment, the higher the regulatory requirements should be, because an investor would like to know immediately, if I invest in a specific company, in a specific market segment, what is the risk? And what may be the return? And everybody fully understands, if I invest in a high-risk market segment, high-risk company, I am expecting higher return. But I would like to know that the segment or the company bears a higher risk than all the others.
With respect to the UK VCTs and the closed-end funds, what is a typical gearing that you see in this low level of the cycle? And how will that be affected when we get back to more normalized interest rate environment?
So at the fund level, there's no gearing at all. So on the portfolio company level, what we typically see is that because the companies being invested in are so small, the banks don't want to support them. So there may be a commercial mortgage or some invoice discounting, but there'll be very rarely any term loans, occasionally some mezzanine finance, but really not very much at all. I think that's one of the advantages actually of investing in the very small end of the private equity market, because as we come to sell businesses, we quite often sell them to larger private equity firms. And we sold a business last year where we asked banks to provide quotes for the debt they would provide so that all the bids could be on a fairly even footing from a number of private equity firms. And this small company making 2.5 million euros of EBITDA was offered 6 times EBITDA by a perfectly reputable bank. And that's certainly a trend that I see in the larger part of the market. So it was interesting to see Michelle's points about is there a bubble, because what I'm seeing is that the larger funds, companies investing 20 to 100 to 200 million euros, are getting a lot more bank support. It feels like the bad old days where companies were being individually over leveraged, and it feels like there will probably be a correction when that vintage comes home to roost, because everyone is having to overpay. They have a lot of cash, they have to deploy it. But at the very small end of the market, I think it's quite right. Banks shouldn't be taking equity risk. I think that's where, certainly in the UK, some went wrong before the financial crisis. They underestimated the risks and they don't have the returns that balance for that. And actually for us investing at that end, there's that opportunity to refinance investments once they've gone from quite small to just a little bit more developed, and the banks are then interested again.
If there is no question, just one more question. What sort of investors you think that would invest in listed private equity or listed venture capital, as opposed to the traditional type of investors that would invest in a normal, not fund, but a normal listed company? Is there a different style of investment? Are there any usage or typical type of investors? Are there family offices? What is the type of investor that is going to invest in those type of vehicles? The question I raise this is, we already see at least 65% of foreign holding in Greece in the normal listed companies. And the question is, the listed funds, would they attract those plus new type of investors?
Well, I can speak primarily for the private client world. We are encouraging our larger our clients with large portfolios to maybe have 4, 5, 6, 7% exposure to listed private equity. But on a wider front, I've seen a study where major financial institutions, pension funds and so on, are putting a similar weighting to alternatives, including listed private equity. And the numbers are becoming extremely big on a global basis. Can anybody else add to that?
Yeah, maybe just a few words on that. What we realize is that also investors that typically in the past invested into closed-end funds, for example, insurance companies or pension funds, are now driven by the regulation to invest in more liquid assets, also in the alternative space. So there is I would say, not an obligation, but the regulators and audit companies are expecting insurance companies, for example, to value their closed-end private equity investment at a daily or at a more regular basis than in the past, which then means the question is, why don't we invest into listed private equity? Because then we can also exit the investment whenever we want. So there is also a trend from traditional investors into traditional private equity funds to invest into more liquid structures in that space.
Just if there is no other question, I would like a closing comment for starting from Nicola. If we say the evergreen vehicles, what would be your comment about the trend in the future? Are they going to be there, increasing in perception of the retail investors and the other investors?
If I had the crystal ball, my impression is definitely the model, especially for venture capital, the model of closed-end fund needs to be rethought. We have been discussing about that at European level, and honestly, all the potential limited partners that we do meet are looking for more liquid assets. So definitely I see that if we manage to establish a more, as let's say, a common way of doing venture capital, a listed fund, that would be much beneficial also for portfolio companies. Because not to mention that the exit times in these days are getting longer and longer. So the model of having a 10 years fund is significantly under stress. Recently talking with EIF, they mentioned to me that at least 1/3 of their venture capital funds portfolio is stretching the life because exits are taking more time than expecting. And what we see, at least in venture capital industry, is longer exit time, lower valuation coming, especially in the recent month, etc. So we need more time to make our company growth, and the listed vehicle would be much beneficial for both investors and portfolio companies.
Yeah, I can only agree to Nicola. What we have seen is before 2007, the time when an exit was done was around 4.9 years, and we are now far above 8 years since 2007. And additionally, also the new regulations on European Union level, like the Capital Market Union concept, the SME growth markets, which are reflected in the MiFID directive, that will support listed equity vehicles.
I also totally agree with Nicola. I think the important thing that I think in VCTs, which are evergreen, that we benefit from are the ability to raise money regularly and not being stuck in, as a traditional private equity firm would be, typically investing one fund, proving some success, maybe 5 to 7 years down the road, raising the second fund and going on like that. And I think the second thing is actually being able to optimize the timing for exit. I think that's a key point. There's nothing more soul-destroying, I suspect, than a GP, the fund manager, being forced to sell a company that they know within a couple of years is going to be worth maybe 2 or 3 times more. So I think that works fundamentally with that market as well. So I hope there will be.
I think all I can say in conclusion is that it must be worth pursuing these options, whether through the smaller venture capital trust type vehicle or through the larger listed vehicle. It might be a difficult path, but it must be worth doing because it can bring in sources of money that otherwise would not be investing in your country.
Well, personally, I'm very optimistic on listed private equity because, as I said at the beginning, many institutional investors are looking for liquidity also in alternative assets. However, we have to be realistic. I mean, the largest part of private equity is still in the closed-end business. And the total market cap of listed private equity on a global basis is around 120 billion US dollars. So it's still a niche market, but it's a growing niche market. And personally, I'm very optimistic on this market. But it will, I think, the largest business in private equity will always be the closed-end business. But the proportion of listed private equity will definitely increase in the next coming years.
Thank you for sharing all your experience and thank you for your patience. And we can now maybe proceed to some more relaxing, like a hotel or coffee. Thank you.